let's get class going. Today, everybody, we are going to be talking about continuing our class, our beginner intro class on option contracts. This is Options 101. So, all you beginners out there who want to trade options and short term or long term, you're going to need this basic information either way. So make sure you're locked in. I'm going to give everybody a moment to lock in, get your notepads ready, get ready to take some notes because this is the foundational information that's going to carry you through your investment and trading career. Okay? So we want to make sure we have this understood. These are the fundamental rules. Well, these are the fundamental tools you're going to use. We're going to set some fundamental rules after I give you the tools. I'm going to give you the tools, and I'm going to give you the rules on how to use these tools. And that's going to help you develop and have a more successful portfolio in terms of option trading and investing, because this can get really slippery, and a lot of people give up on trading and investing because options do not go well for them. But a lot of people jump into options with no rules. They jump in with very minimum knowledge, and they're looking for quick money. The issue with options is that it does provide quick money, which is a blessing and a curse at the same time, because that quick money gets people hooked into thinking that this is what the stock market does on a daily basis, 100%, 200% returns. You'll get that every once in a while with options, but don't think that to be an every week occurrence unless you're an options master, and then you could teach me and let me know what you know. Or let everybody know what you know, because I don't know anybody out there that's doing that with options right now. Okay, options are going to get you, and you're going to get options. But the more rules that you have in place, the less you're going to get got by the options, all right? Let me send out this message really quick, give people more time to tap in. If you have any friends or family that you know that are interested in investing or learning about the stock market, please share this channel with them, share my YouTube channel, share the TikTok Culture Shock Investments with your family. I'm here to teach and give out free gems to the black community because we all need to know the basics of investing. It is not maybe I could learn this, or maybe I should know this, or maybe not know. This is like knowing how to cook almost. Like, you know how some people know how to cook and they're not maybe the greatest cooks, but they could fend for themselves if needed be. You know, you need to at least have that level of knowledge in investing where you don't have to be the master investor. You don't have to be Warren Buffett. You don't have to do any of that. You don't have to get up to that scale of skill, but you have to at least know how to cook so you could feed yourself. If you don't know how to cook anything, you can't even feed yourself. No matter if the food tastes good or bad, you have to be able to feed yourself. So this is learning how to cook. Cooking 101, aka Options 101. We're going to learn how to chef up the market, all right? Because this is a skill set, like I said, you have to have, especially in the black community. Let me give people another second to join. We're going to get this started right now. All right. I think we should have given people enough time to get your notebooks ready. And let's get this class started. So, last class was the introduction to options. Now we're going into contracts and Greeks. I'm going to go over some of the similar stuff I went over into the intro, because the intro was like a brief overview of everything that involves options. And now we're going to get into the nit-gritty details of what each one of these terms mean, okay? So let's get this started. You have, hold on. They want to start there. I must have put that up top by mistake. That's for the end. All right, let's open this up. So you have strike prices. I call an option contract has something called a strike price. This is going to be your chosen battlefield. This is where you're going to find what price you want to buy or sell your contract at. So your strike price is where you're saying the stock is either going to go or it's going to hold above and get higher above or lower below. So if you're in a call, remember calls are if you're projecting the market to go up. If you're in a call, your strike price is going to be either equal to where the price is now, or you want to maybe put it lower. That would be considered in the money if you go lower than where the price is now, because that means the price is already above your strike price. Or you go out the money, which is above the strike price, which would be, let's say, $100 company. Let's say Nike's trading at $100, and you want to get $110 call. That's out of the money. In the money would be $90 call because it's already past 90, and $100 call would be an at the money call. Same thing on the put, it's just the opposite direction because in the puts you're looking for things to go down. So in the money would be below the stock price. So if you got if you had a $90 put and Nike's at, if you got a $100 put and Nike's at $90, you're currently in the money on your put. If you have a $100 put and Nike's at $110, that would be considered out of the money. So it's just the inverse of calls, okay? Just think of it like that. And think of your strike price as the target zone where your contract is going to start paying off, or the delta will start to increase. So you have a strike price, right? Let's say you have a strike price on Nike, $100, premium $2, expiration 30 days. If Nike rises to 105, like I just said, you're in the money. But what you want to see is when you get in that zone, you want to see what we're going to talk about later is the Greeks. You want to see that delta increase. And that's going to determine how much money you're making for each dollar the stock moves up or down. But right now, I just want you to remember strike price is your target zone. That's the price where you're picking and saying this is where I think the stock is going to be. It's either going to get higher or lower than this price that I'm picking. And I think I want to use this as my zone of entry. All right, you could go in the money, which is a safer zone, out of the money, which is a more dangerous battlefield, or at the money, which is pretty neutral battlefield. It could go either way on you right there, and you won't get hurt more because it went the opposite way of what you thought versus when you went out of the money. Out of the money is a dangerous battlefield. We'll talk about that in a second. Like I said, calls, you want the strike price above. You want the stock to close above your strike price, and for puts, you want it to close below your strike price. Remember, puts down, calls up. Call it up, put it down. That's how easy way I remember it for calls and puts. Now we're going to talk about expiration dates. Time is your enemy. Time. Time is theta, okay? That's what time is. Time represents theta. It's one of the Greeks. And when you get into an option investment, you're pretty much going for two things. You're going against the price movement, which you want to flow in the direction whether you think it's up or down. But your biggest enemy in option contract is, believe it or not, is not the price moving away from your strike. The biggest enemy is time. So let's say you buy an option contract that expires this week, right? And you're wrong about the price movement. And you said you feel like Nike was going to go up in its price. So you got the $105 call and Nike was trading at $100. And throughout the week, because your contract expires on Friday, even if Nike creeps up slowly, if it doesn't creep up fast enough in comparison to how much you're losing for theta over the time each day, you'll still end up losing money. So you can see, this what confuses people a lot when they get into options. You could get into, like I said, that $105 call on Nike. And over the course of that week, from Monday to Friday, it could be losing $50 a day in value. But for every dollar it moves up, it gains $20 in value, which is not the greatest contract, so you probably wouldn't want to be in it anyway. But let's just use that as an example. So now every day that passes by, you're losing $50 in value. And even if Nike goes from $100 to $101 from Monday to Tuesday, it goes from $100 to $101. You lost more in the time decay, what they call theta, time decay. You lost more in that than you gained in the delta move of the stock going up $1. So you could have Nike go from 100 on Monday to 101 Tuesday, 103 Wednesday, 104 Thursday. But if your contract, if the theta, it keeps hitting harder than the delta is going up, you'll see the price is going up, but somehow your contract is still going down in value. And that confuses a lot of people when they first get into options, because it's like, the price is going up. I said the price was going to go up, and it's going up this week. Why am I not making money? It's not going up fast enough comparative to the time that you bought. If you did that same contract on Nike and you bought a contract that was 3 months out and said it was going to go to $105, and it took one day at a time, and through 1 week it got up to $105, you will be making profit each day, because your theta is going to be so much smaller than your delta. Remember those two Greeks, the theta and the delta. Those are my favorite ones to compare and contrast and look at when I'm looking at an option contract. All right. If you're getting into an option contract and your theta, your time decay, is much higher than the delta, how much money you're going to make or lose on a stock going up or down $1, then you want to look at other contracts. You want to look at something that is a better ratio. But we'll get into that later. Right now, I want you to think of time frames when you're investing then, okay? When you think about theta, you got to think, I want to get as much time as I can afford on my contract in order to give me the best chance to come out with profit. That's why I tell people to buy time. You have to buy time on your contracts because that is your biggest enemy. If the more time you buy, the less pressure you have from that enemy of theta. So I like to do sometimes monthly contracts, which would be contracts that expire the third Friday of each month. And those are good if you're going to be swinging contracts from month to month on a stock. And like I said, it gives you time for that price to move up and down for you. It gives you a good 30-day period before your contract starts to get ready to expire worthless. A weekly contract expires every Friday. This is good for the short-term traders and investors that you may see a short move coming in the market or a move that you see coming in the short term, but you're not sure how long it's going to sustain, so you want to take advantage of that and get in and out. All right, you're looking for the in and out. They call it scalping, but I wouldn't consider weekly every Friday. I wouldn't consider weeklies as a scalp. If you're doing 0-day trades and jumping in and out day trading every day, then you're scalping. But you could get weekly option contract and not be considered scalping a stock. So this is a contract. If you get this contract, let's say you got this contract tomorrow, this contract would be the contract that expires Friday. All right, you could get a contract this upcoming Friday that expires the following Friday, which is the way I prefer to play it weekly if you're going to play the weekly contract. It gives you more time, it gives you the weekend move and then the whole week to follow through on that move as well. Then you have leaps. Leaps are considered 1 year or more, I would say. 1 to 2 years out. Option contracts, those are considered leaps. Those are almost as solid as actually buying the stock. But the closer you get to the expiration date, the more it starts to function like an option contract. So if you want to own a large amount of shares in a company, but you can't afford to buy 100 shares of the stock, you could get a leap. One contract, remember, one option contract equals 100 shares. So if you get a leap on something like Microsoft, maybe you can't afford 100 shares of Microsoft, but maybe you could afford the option contract that expires 1 year out, and you could get maybe one contract that gives you control over 100 shares of Microsoft for the next year or 2 years, which is a great way to play it if you are looking to build up your long term, and then you could take those gains and actually buy the shares because you ultimately always want to have ownership. Option is like renting. Think about that. You could do long-term rental, short-term rental, or you could be like a hotel or Airbnb where you're just staying for the night or the weekend. Think of options like that. And if you're going to do a long-term leap, yeah, you're still in there for 2 years, 3 years, but at the end of the day, you still don't own that house. Don't get caught in the man. You might have decorated it, might have put pictures up, paintings, repainted the room in those 3 years, had a baby in there, everything. Could have did all that. But guess what? At the end of the day, you still don't own that house. The owner owns that house, and you got to relinquish control back to the owner. And that's what option contracts are. So you want to do a leap, you want to do that, and you want to make sure that you are, if you're in a good company, that you convert that into shares. Because you don't want to sit on a leap and let it get close to expiration and then you start losing value drastically. Because just like a weekly option, once a leap gets close to expiration, it starts operating more like the monthly. Then it starts operating like the weekly. Then it becomes like a daily contract, and then a 0 day. And then through all that, it's going to continue to lose value rapidly. So you have to be very careful, very, very careful with that. All right, so let's move on to the next slide. Reading an options chain. I'm going to bring up an options chain for you guys to check out in a second. But let's get to basic terms. You got reading an options chain. You got the column. You got the strike price you're going to see, which is the price levels offered, which is going to be in the middle. You're going to have all the different strike prices that you could pick from. Then you have the bid and the ask. The bid is next to the strike price. It's going to tell you how much people that are trying to buy that contract, how much they're trying to buy it for. And then the ask is going to let you know people selling that contract, how much they're trying to sell it for. And there's always a battle between the bid and the ask price, the bid and the ask price. You want to make sure that you don't If you're a buyer going in, just like you would if you're trying to buy, um, let's say, a piece of art. These things have flexible prices, or even a car. You can negotiate the price on. You want to go in there. There's a certain price that you're not going to get it for less than, but there's a price that they're asking that is pretty capped. You don't want to get it for the cap price. You want to get it somewhere in between. So you want to ask, all right, between, let's say, the bid price is $100 and the ask price is $150. You don't want to just go and pay that $150 unless you're really desperate to get in. You just want to get in now, and you don't care. And you're really confident that it's going to be worth more than that $150 very soon, or you're just looking to get in immediately. Now you could do a limit. That would be a market order. They would put you right in at the ask price. That's an option market order. It's going to give you the ask price, whatever people are selling it for. That's the exact price the market is going to make you buy it at. But you do a limit order. A limit, you could pick a price between the bid and the ask, where you could say, okay, they're selling it for 150. People trying to buy it for 100, and the people that's trying to buy it for 100, they may have to wait a while for the price to come down. But I want to get in, so let me go ahead and put an offer in at 125. So you come in between the bid and the ask, and that is going to be the price that you hope your contract executes at. And more times than not, you pick a good little gap between the bid and the ask price, your contract will execute. Unless it's a very volatile stock and it's just going up very quickly. Then you're going to have to start what they call chasing the stock, and you don't ever want to have to do that. And then you're going to see it says last price. Last price is the most recent trade price that you're going to find on there. And you're going to have the volume. How many contracts traded today? That's very important when you're looking at volume. When you see how many contracts traded today, you want to know, is this a high volume contract or not many people are trading a low volume contract? And then you have open interest. The open interest is the total amount of contracts that are still open at that strike price. So how many people are still holding contracts at that strike price is the open interest. And that'll let you know, wow, if it has high open interest, that means a lot of people are still holding this contract, means that a lot of people still believe that the price is going to go to this level. So a lot of people who are trading options, they look for what price on both sides of the strike price has the most open interest, and they'll know that's the price that the market makers or the institutional investors are looking for that stock to hit that price before they collect their profit and get out, or a continuation for it to happen. And then you have implied volatility. This is going to show you how volatile that option contract is. All right, you have a contract with high implied volatility, means that it's more likely to jump up and down in value very rapidly. So those are contracts that you definitely want to take profit on quickly, especially once you make your money. You'll see 0-day contracts have high implied volatility. That's because their value could go from $100 to $0 within 5 minutes. So once you have a option contract and you see the implied volatility is above a certain threshold, I like to say implied volatility is above 70 is going to be pretty much getting close to 0-day volatility levels. So if you got implied volatility is above 70, 80, then you want to be careful and say, all right, once I make money on this contract, I need to take money fast. That's all that's letting you know. When you make money, take money fast, because it's going to go up rapidly, but it can also come right down rapidly too. So you'll see a lot of companies out there. Those are the companies that people tend to want to lean into the most because they make money really quick. But like I said, the inverse is you could lose money very quickly as well in those option contracts. Let me pull up the chart for you right on the option chain. So this is what we're talking about right here. This is the options chain. This is what you're going to see when you open up your options on your. This is TradingView. This is the platform I like to use. All right, and this is Apple. So in the middle, you see here, you see these strike prices. These are all the strike prices right here in the middle. So Apple is currently trading at $268. So you could start buying above it at $270 or below it at $265, and then you could go down from there. But see this implied volatility I was talking about? You see how the further away I get from where the current price of Apple is, the higher that implied volatility gets, because these are more volatile contracts. They move up and down faster in value. Now, this can be good and it can be bad, like I said, but you have to know that based on the research you're doing on the company. If you have high conviction that a company is going to move a certain amount of certain amount of dollars in a certain direction, let's say after earnings, or you got in some inside scoop, or you've just been doing your research on the company, you know a product is getting ready to come out. Sometimes at that point, the high IVs are the best options, because what happens is if you are anticipating a move that's going to come in and you're correct, the high IV contracts, let's say we each put $1,000. You put $1,000 into $140 put on Apple, saying it's going to drop down to $140, and I do that same contract, and I put 100 on the put for 260. As we get down to 140, what's going to happen is if we put the same exact amount of capital in, let's say you put 1,000, I put 1,000. What's going to happen is by the time it gets down to 140, you're going to have made much more money than me, because this contract had a much higher implied volatility, which means it's most likely going to move up in value much faster than the contract I got here. But that's because you took a higher risk by going so far out the money. So risk, high reward. Same logic that applies in life. You know, sometimes you got to measure and know your risk tolerance before you take a risk, because if you go outside your risk tolerance, it can end up crashing you out or destroying your account. So you got to be very cautious of this implied volatility. Like I said, anything over like 70, you're getting close to 0-day movement territory. Honestly, like over 50. 50, I would say try to below 50. But you'll notice that on more volatile stocks, like this is Apple. So if we type in something like, let's say Coinbase has high implied volatility and is right near the strike price. That's just because this is a volatile company. So it moves up and down rapidly on its own any given day. So the implied volatility, even if you're close to the money, is still high. So like I said, 63, what did I say? Over 50, close to 60, you're moving like a 0-day. So you got to be careful on getting contracts with implied volatility above 50 or 60. You're going to get rapid movements, but that also means you could lose money quickly. All I say is that when you get into high IV, I'm not steering you away from it. You just got to increase your focus. You have to have increased discipline. If you have a take profit target, you have to take profit at that level. You cannot say, oh, well, let me see if it keeps running and I can keep taking. No, implied volatility is too high. Take your profit, get out of there, and if you see continuation, set that price level for that continuation, and you can continue to go from there. But don't stay in these high IV trades for too long unless you have a lot of time on your side. And even then, this is a December contract. This expires December 12th, and it still has a 60 IV. For these high IV companies, I tell people go at least a year out. A year or two out, and you still get high IVs on these companies, but at least you got time on your side then. You know, you got to put something on your side to give you an advantage when you're doing these volatile companies. And yes, going far out costs a lot of money, but then that's not the company for you to trade if it's too much money for you to go far out and it has a high IV. Okay? Let's go back to Apple. I don't want to scare y'all with Coinbase IVs. Let's go back to Apple. All right, so Apple, remember we said asking the bid price. You see this is the put side right here. This is calls on the left side. So you see you have the bid and the ask price. The bid and the ask price, what did I say? The bid is what people are trying to buy it at, and the ask is what people are trying to sell it at. You see the small gap in there? So 7.3, $7.30 option. Remember times 100 from lesson number 1. If you're not sure how to read this, go back to lesson number 1 so you can catch up. 7.3, this is $730, the bid. And the ask, they're asking for $765. So I might come in somewhere in the middle and say, you know what, I might buy it for $740. And you see that's the most recent price that it's sold for right here. This is the last price. So this will be $740. This is the most recent option contract. This is what it's sold at. So you could do the comparison between these three prices and find your best entry. Or if you're just trying to get in on the contract now, you just put in the market order. It's most likely going to fill you at this ask price though. So the most expensive price. Then we got over here, these are the Greeks where you see the delta, gamma, theta, vega, rho. We're about to get into that right now. But most ones I was talking about, the delta and the theta were the two I was talking about the most. So the theta, this is how much your contract is going to go up or down in value each day that passes by. The delta, this is how much your contract is going to go up or down in value for each dollar that the stock moves, okay? Keep that in mind. That's very important distinction to understand. Those two Greeks right there. Let's move on. In the money, out the money. Very important to understand as well. Are you buying an in the money contract, out of the money contract? Is your contract at the money? You want to know which one of these scales you're buying in, okay? In the money, option already has intrinsic value. What they're saying is that the option is already above the strike price and is currently sitting at or is sitting above it's sitting above your strike price, and it currently already holds some intrinsic value. So you're looking to buy the $100 Apple calls, and the Apple price is at $105. It already has $5 of intrinsic value on it, making it a safer contract, but it's going to make it a more expensive contract to buy because it already holds some value inside of it. A lot of the times when you get an out the money contract, it has no intrinsic value because the stock hasn't even reached that price yet. What you're gambling on, or what you're looking to happen, is for that value to come into that contract. But in the money already has that value, okay, which is why they cost more, and are the deltas are usually pretty strong on these, but like I said, they cost more money. So it's a safer play, it's a more secure play, and you can still make good money on it. Don't get any twisted. In the money plays make a lot of money, so don't sleep on getting in the money contracts. And that's what people who do leaps and who have large accounts. This is the option. These are the contracts I tend to see them buy. They tend to get leaps that are in the money. So we see Apple at 200. Let's say that's $100. Let's keep $100 in. Let's say Apple at $100, right? They'll buy a contract call on it that's 2 years out, but they'll get the $90 call. So they already have $10 of intrinsic value on that contract, and it's a year out. So they got intrinsic value plus time. And when you have money and you can afford it, why not do that? Because you're giving yourself the highest percentage chance of coming out with profit at the end of this year. And that's all this game is about. It's not about making the most profit in one trade. It's not about 100% returns. It's about increasing your chance of making money as much as you possibly can, to close as you possibly can get it to guaranteed returns. Guaranteed returns like bond market. The bond market is so much bigger than the stock market because it has guaranteed returns. Even if it's only 5%, 4%, people gravitate towards guaranteed returns. So when you have a large sum of money, or you have an account you're trying to protect, leaps in the money, that's the most safest way you can play options. Okay? Then you have at the money. At the money is Apple's trading at $100, and I'm going to buy the $100 call or put right here. So you're not in the money in any kind of way, and you're also not out of the money. You're buying the stock right where it's trading at. And wherever which direction it goes, if you're a call, if it moves up from that strike price, you become in the money at that point. And if it goes down from your strike price, guess what? Now you're out of the money. Out of the money is when it has no intrinsic value, like I said. You're buying something and you're hoping for it to get to that level. And because you're taking that risk, the closer it gets to that level, the more money you'll make. And because you're taking such a high risk on buying something that really has no value, they're going to reward you more as value comes into it. Oh, excuse me. So let's say you have a stock at $90, Apple's at $90, and you get the $100 call. There's no intrinsic value there in the contract yet. But let Apple jump from $90 up to $101, and you have $1 of intrinsic value. You're going to make a lot more money on that because you took a big risk. And it was no guarantee that it got there, but you did your research, your charting, your levels, and everything that we do in the culture shock community, and you saw that $100 move was likely, so you're able to take advantage of it. Let's go risk and reward reminder. Every contract has risk, but the risk is limited. The risk is limited to what you spent on the contract, but that can go to absolute zero. You will not go negative. It's not going to be, oh man, I bought a contract at $100 and the stock went from $90 down. I bought a call for a $100 call and Apple went down to $70. I'm not going to go then lose all the money I put on the contract. Say you spent $200. You're not going to lose your $200 and then go into the negative on $200 because the price keeps going down. It'll just stop. It'll just stop at zero and you can't lose any more money at that point. But on the upside, it's unlimited reward. Because if Apple goes from $100, let's say, up to $1,000, your option contract will continue to go up in value. It won't stop. It will just keep going based on what the delta is telling it and all the Greeks in the market, what they are saying, okay? So unlimited gain potential, limited loss potential, which is why people love options. but it can be very addicting and risky for people who don't have the risk tolerance, because you keep putting in that little bit of money and you keep losing it all. Then guess what? Your risk is no longer limited. Your risk has now become unlimited, just like your reward. And you don't want that. You want to keep it at limited risk, unlimited reward. Now let's get into these Greeks, the good old Greeks. I have something to say about that with the Greeks, but I'm gonna use that. I'm gonna leave that for my Black Empowerment podcast. We're gonna talk about this though. Let's talk about the Greeks. Greeks who got a lot of their knowledge and information out of Kemet, or yeah, what you guys know now as Egypt. But the Greeks, they got the Greeks called the Delta, the Gamma, the Theta, the Vega, and the Rho. You'll see all these little symbols next to them. These are the symbols that represent those Greeks. And the Delta, like I said, represents the stock price movement. How much the option contract is going to move for every dollar the stock moves. That's what the Delta is going to tell you. So a Delta 50.5 is going to let you know that it's going to gain 50 cents in value for every dollar that the stock rises. Now remember, 50 cents is 50 times 100. So that's $50 for every dollar that the stock goes up. Because remember, we're dealing with options. You're holding 100 shares. So 100 shares, where the hell did my clicker go? For 100 shares at 50 cents is going to give you $50. So for every dollar that the stock goes up, remember, I want you to start thinking of these as multiplied by 100. But these are the premiums. This is how they're going to show it to you. So you'll get it in your mind eventually as you start trading options that 0.50 is $50. So for every dollar the stock goes up, that's how much you'll make. And you want to pay close attention to that in comparison to, what did I say? The theta, that time decay. How much value the option loses per day. This is essentially your rent payment. You're going to pay rent every day. And you're going to see how much, usually by the end of a contract, your rent is going to have to be paid all the way up. So theta is set up in a way that if the price isn't going up from where you bought at, and time keeps going by and the expiration date comes, all the money's gone. You don't get to hold on to not a dime, a dollar, a penny. They'll take it all. Then Gamma, let's see, Delta's rate of change. How fast Delta changes when stock moves. Control how explosive stock profits can get near the strike. All right? I don't use that one too often. And then you have, where is it at? Where is it? Yeah, I think those are the main ones right there. I don't think you got to go for anyone past that. I think that should be good. That should be good. All right. All right. Well, I think that is it. I don't know who else is waiting. Let's see something. Okay. All right. That makes sense. I think I got. Wait, hold on. Where the hell is this page at? Hold on, y'all. Hold on. Just trying to get this page back up. Where the hell? All right, I think I got it right here. I don't know what the hell just happened to my computer. That shit just froze like a mug. Give me a second, y'all. Get this up and running. Oh man, what's wrong with this thing? What's wrong with this thing? Why is it not working? I hope y'all can see it on your side, but I'm just gonna try to push through this so we could get to the end. But I don't know what's wrong with this. It's not why it's not working like it's supposed to. All right. Anyways, let's go ahead and finish this up. We have, that is pretty much, like I said, the Delta, the Theta are probably the two things I worry about the most right now. You can grow into learning more about the Gamma, but really the Delta and the Theta are the things I will focus and be impacted by the most for right now. And the risk and reward, you can only lose what you pay on options, okay? You can't lose more. They're not coming for your debt. They're not going to come for more money than what you put up, okay? You can only lose what you put inside there. You're not going to lose anything more than that. Now, if you start getting into different types of trading and different types of, I'll try to fix this. If you start getting into different types of accounts and you start doing leverage and loans, then that's a whole different kind of category. But for most cash accounts, you can only lose what you put in. All right, so you're not going to go more negative than what you already put up for grabs. So always be careful what you put up for grabs. Always be cautious of how you're investing out here. But always come back and ask questions again if you are confused about one of those platforms, whatever platform you use that you're most comfortable with. I want you to write in your notebook what should happen if the stock that you're looking at goes up $1. What happens to that option contract? You should know what to look at to find what happens if it moves up or down $1. How much time value would I lose by tomorrow? You gotta know what to look at in order to see what time value is coming down. What would happen if volatility drops 5%? I want you to know what's going to happen and how those numbers are going to change with those volatility changes, okay? If you have any questions on how to track all that, I want you to reach out to me directly. You have us inside the Discord. I want you to sign up for Culture Shock Investments Discord. Become a Culture Shocker today. You can become a basic member, or you can become a lifetime or advanced member where you get access to everything for life and access to all the classes and courses that I do. These are free courses that I do for now. I'm doing all the beginner classes for free. And as we go on to more advanced classes, those are going to be paid for classes that are only available to the Culture Shock community. But I do believe everybody deserves access to the basic information, especially in the black community. Like I said, you don't have to become an expert at cooking, just like you don't have to become an expert chef. But you should know how to make some eggs, all right, and some toast at least. You got to be able to feed yourself. And that is the main key of learning the basics of investing. You got to know how to store your money and save your money enough to feed yourself in the future. You do not want to get into this and end up drowning. Get into this too fast without learning properly and end up pouring in all your resources and now you're drowned. Okay? So if that's the case, you want to learn properly, you got to visit us on TikTok, Culture Shock Investments, YouTube, Culture Shock Investments, and Discord, more importantly than that, is the community where I am being able to be contacted directly. Of course, if you leave comments on this video, I will reply when I can, and look forward to talking to you all next week. All right, let's keep it going. I'm going to get more information on options. This is just the beginning. I got to teach you guys some different option trading strategies and dive deeper into the Greeks, and we will build from there. Thank you all who came through this week. I love you. Have a good weekend, and I will see you next week. Or if you're going to come to the session, I will see you on Monday for the charting session, okay? Monday morning, charting session live right before the stock